In this presentation, we are going to discuss about Accounting Standard 13. That is, accounting for investments. We will try to understand the concepts of this standard in detail. We will deal with purpose of the standard, with what the standard does not deal with, important definitions with respect to the standard, how should the investments be classified, what are the costs of investments, carrying amount of investments, valuation on reclassification of investments, the treatment of investments on disposal. Disclosure requirement with respect to the standard, what are the categories of investments, what is ex and cum interest, and we will summarize it with practical examples. The Accounting Standard 13 is made to deal with the accounting for investments in the financial statements prepared by a company. Moreover, the standard also prescribes various disclosure requirements with respect to the investments made by the company. That is, the investments which are covered under Accounting Standard 13. In the previous slide, we dealt with the purpose and how the standard deals with it. However, the standard does not deal with the following. It does not provide basis for recognitions of the investment incomes, like interests, dividends, rentals, earned on investments, which are covered under Accounting Standard 9, revenue recognition. Operating or financial leases cannot be accounted according to AS 13, because AS 19 provide guidelines for it. Investments made by insurance enterprises and investments of retirement benefits plan are not covered under the standard. And investments made by mutual funds, venture capital funds, investments made by banks and public financial institutions cannot be accounted as per AS 13. So, all other investments, which is not covered by AS 13, should be accounted according to their respective standards. In this slide, we are dealing with the important terms and definitions in this standard. 1. Investments. Investments means the assets held by an enterprise for earning income by way of dividends, interests, rentals, for capital appreciation, or for other benefits to the investing enterprise. However, assets held as stock in trade is not considered as investments as they are not the part of investment of the company. The second important term is fair value. It is the amount for which an asset could be exchanged between a knowledgeable willing buyer and a knowledgeable willing seller in an arm's length transaction. This term has to be known well as it matters for the determination of the price of investment on purchase and sale. However, under appropriate circumstances, market value or net realizable value provides an evidence of fair value. The term market value means the amount obtainable from the sale of an investment in an open market. We will get more clarity on the terms when we deal with the practical side of the investments. How are the investments classified? Mainly, investments has been classified as 2. 1. Current investments. 2. Long-term investment. Let us go through each in detail. A current investment is an investment that is by its nature readily realizable and is intended to be held for not more than 1 year from the date on which the investment is made. Moreover, the intention to hold not more than 1 year has to be judged at the time of purchase of investment. A long-term investment. In simple terms, an investment other than a current investment. That is, which is intended to be held for more than 1 year. And a long-term investment can be both readily realizable and not. In the given example, the investment is intended to be held for 15 months from the date of purchase, which is more than a year. So that, in accordance with AS 13, this investment should be classified as long-term investments, as it is held for more than a year. Cost of investments. It means the total expenditure incurred for the acquisition of that particular investment. Generally, the investment's acquisition is of three types. They are as follows. 1. Investments can be purchased by cash or bank. In this case, the cost of investments include charges related to acquisition of brokerage, duties, and fees along with its basic cost. 2. Investments can be purchased by issue of shares or securities. In that case, the cost of acquisition is the fair value of securities issued, or the assets which are given up. However, the fair value might not essentially be same as the nominal value of securities which are issued. It might be prudent to consider fair value of such investment acquired in case it's more evident. 3. If an investment is acquired in exchange, or part exchange, for another asset, the acquisition cost of the investment is determined by reference to the fair value of the asset given up, or the fair value of the investment acquired, whichever is more clearly evident. Cost of investments on right shares subscribed. In case right shares offered are subsequently subscribed for, cost of such right shares is then added to carrying amount of the original holding. In case the rights aren't subscribed for, however, are sold, sale proceeds from the sale of such rights are transferred to P&L statement. But, where an investment is acquired on a cum right basis, and market value of the investment immediately after becoming X right, is less than the cost for which such investment was acquired, it might be prudent to apply the proceeds from the sale of rights, to reduce carrying the amount of the investment, to the market value. Interest, dividends, and rentals receivables in connection with an investment are generally regarded as income, being the return on the investment. However, in some circumstances, such inflows represent a recovery of cost, and do not form part of income. For example, when unpaid interest has accrued before the acquisition of an interest-bearing investment, and is therefore included in the price paid for the investment. The subsequent receipt of interest is allocated between pre-acquisition and post-acquisition periods. The pre-acquisition portion is deducted from cost. That is, entered on the credit side of the capital column. When dividends on equity are declared from pre-acquisition profits, a similar treatment may apply. If it is difficult to make such an allocation except on an arbitrary basis, the cost of investment is normally reduced by dividends receivable only. If they clearly represent a recovery of a part of the cost. Where an investment is acquired by way of issue of bonus shares, no amount is entered in the capital column of investment account, since the investor has not paid anything. We have discussed the classification of investments in the previous slides. Now let us look, how should the carrying amount of investments be determined? The carrying amount for current investments is the lower of cost and fair value. Any reduction to fair value is debited to profit and loss account, however, if fair value of investment is increased subsequently. The increase in value of current investment up to the cost of investment is credited to the profit and loss account. Long-term investment, it is usually carried at cost. The carrying amount of long-term investment is therefore determined on an individual investment basis. However, where there is a decline, other than temporary, in the carrying amounts of long-term valued investments, the resultant reduction in the carrying amount is charged to the profit and loss statement. The reduction in carrying amount is reversed when there is a rise in the value of the investment, or if the reasons for the reduction no longer exist. When investments are reclassified from current investments to long-term investments, transfer is made at cost and fair value, whichever is less, as at the date of transfer. Similarly, when investments are classified from long-term investments to current investments, transfer is made at cost and carrying amount, whichever is less, as at the date of transfer. Disposal of investments means the sale of shares, debentures, and other investments made by an enterprise. And that can be happen, either partially or fully. If a company plans to dispose its entire holding, then, on disposal, the difference between the carrying amount and the disposal proceeds, net of expenses, is recognized in the profit and loss statement. Or, if a company plans to sell a part of its holding, then, on that part disposal, the carrying amount is required to be allocated to that part, either on the basis of the average carrying amount of the total holding of the investment, or on the basis of FIFO, first in first out. These are the disclosures requirement in the financial statements with respect to AS 13, accounting for investments. 1. Accounting policies employed for determining carrying amount of investment should be disclosed in the financial statements. 2. The amounts which are included in the profit and loss statement with respect to interest, dividends, and rentals on the investments, presenting the income from such long-term and current investments separately, and profits and losses on the disposal of current investment and long-term investment, and the changes in carrying the amount of the investment. 3. Significant limitations on the right of ownership, realizability of the investments or remittance of income, and proceeds of disposal have to be disclosed. 4. The total amount of both the quoted and unquoted investments, providing the total market value of the quoted investments. 5. Other disclosures as explicitly as required by the relevant statute governing the company, should be made in the financial statements. Investments can be categorized on the basis of its income. There are two types of investments mainly. 1. Fixed income-bearing investments, like government securities, debentures, bonds, and 2. Variable income-bearing investments, like equity shares. Let us discuss the types of investments in details. Fixed income-bearing securities refer to a type of debt instrument that provides returns in the form of regular, or fixed, interest payments and repayments of the principal when the security reaches maturity. The instruments are issued by governments, corporations, and other entities to finance their operations. Transaction for fixed income-bearing securities may occur on ex-interest basis as well as in cum interest basis. In case the transaction is on ex-interest basis, the amount of interest accrued to the date of transaction has to be paid in addition to the price of security. Variable income-bearing securities refer to investments on securities that provide their owners with a rate of return that is dynamic and determined by market forces. It provides investors with both greater risks as well as rewards. Investments in equity shares come under this. The following points should be noted with respect to investment in equity shares. 1. Dividends from investments in shares cannot be recognized in the statement of profit and loss statement until a right to receive payment is established. 2. The amount of dividend accruing between the date of last dividend payment and the date of purchase cannot be ascertained immediately. When debentures are purchased before the date of interest, then a problem may arise whether the quoted price of debentures includes interest up to the date of purchase, or not. Price may be quoted ex-interest or cum interest. When the interest accrued from the last due date of interest to the date of transaction is included in the price quoted, it is called cum interest price, which is the total amount paid for the purchase of debentures. Thus, cum interest price can be computed by the summation of payment towards capital portion and payment towards interest accrued from the last due date of interest to the date of transaction. When the interest accrued from the last due date of interest to the date of transaction is not included in the price quoted, then it is called ex-interest price or real price. So, X interest price is the payment towards capital portion of the investment. How the transactions on X interest price and cum interest price of fixed income bearing securities to recorded in investment account. We will first discuss about purchase. If the purchase is on cum interest basis, then the amount in the capital column should be the purchase price less interest accrued till the date of transaction. And if the purchase is on X interest basis, then purchase price of the investment is the amount to be entered on capital column. That is, no impact on interest till date. In case of sale, if the transaction is on cum interest basis, the amount of accrued interest from the date of last payment to the date of sale is credited in the income column. And only the sale proceeds, net of accrued interest, from the date of last payment to the date of sale, is credited in the capital column of investment account. And if the transaction is on X interest basis, entire sale proceeds is credited in the capital column and the amount of accrued interest from the date of last payment to the date of sale, separately received from the buyer, will be taken to the credit side of the income column of investment account. Let us move on to the practical parts of the presentation. First, we can analyze the question in short. Messrs. Bull and Bear purchased 10,000 debentures at cum interest price by paying a brokerage 1%. And he sold the holding within 5 months at a cum interest price of Rs 106. Again by paying a brokerage of 1%. So we have to prepare investment account for posting this transactions. Initially, we will discuss about the journal entries. On December 1st, Messrs. Bull and Bear purchased 10,000 debentures at 101. So, the journal entry will be investment account debit, Rs 10 lakh and 100 only. Interest accrued account debit, Rs 20,000. Bank account credit, Rs 10 lakh, 20,000 and 100 only. So, we will check about the amounts on the entries. The cost of 10,000 debentures is equal to 10 lakh and 100 only. That is 10,000 multiplied by 101. Add the brokerage at 1% of the actual cost. Rs 10,100. Then, less the interest accrued, as it is on cum interest price. So less 20,000. So we will get Rs 10 lakh and 100 as the net cost of investment. Interest accrued amount computation can be easily understand, if you go through the working notes. So I think, no need of explanation for this. Okay. Then we will move to the second entry. Journal entries for the sale of debentures. Bank account debit, Rs 10 lakh 49,400 only. Investment credit, Rs 999,400. Interest accrued credit, Rs 50,000. Here, 10 lakh 49,400 is the net amount paid excluding brokerage. And the amount in the investment account can be computed as follows. Aggregate sale amount is 10 lakh 60,000 rupees. That is 10,000 multiplied by 106. As it is a sale, brokerage should be deducted at 1%. So, Rs 10,600 has to be deducted. Then, as the sale is on cum interest price, cumulated interest also need to be deducted. Rs 50,000. Computation can be seen in working notes. So, the net amount is 999,400. And the sale has done. So the net interest earned over the investment is to be transferred to P&L account. Rs 50,000 less Rs 20,000, equal to Rs 30,000. And, we have loss on investment, so that amount also need to transfer to P&L account. So these are the entries with respect to this problem, and we will discuss the posting of these entries in the next slide. We have to prepare investment account in the books of Messrs. Bull and Bear for the period from December 1st, 2012 to March 1st, 2013. We see here the investment account in a columnar form, but still it represents two accounts. That is, investment account and interest account. Then, we post the purchase entries first in the debit side. After deducting interest from the total cost, as the transaction is on cum interest price. We have discussed in the previous slide about the computation of the amounts. After that, we will post the sale entries, after deducting the interest from the total amount received. As the sale is on cum interest price, and we have to transfer the net interest received to the profit and loss account, so post it on the debit side of the account. And the loss on investment also need to be transferred to P&L account, so it is to be posted on the credit side of the account. The account will be closed then, as there is no investment in balance. It is the workings of the problem, and we have discussed it, so it is not necessary for a further explanation on this. We will study one more problem regarding the investment in equity shares. Let us analyze the problem in brief. Sunder purchased 25,000 shares of X Limited at Rs 15 per share. And again he purchased another 5,000 shares of the company at Rs 16 per share. Then, company announced bonus and right share, but no dividends was payable on these shares. And the question says about the terms of issue of bonus and right issue. Sunder sold 1/3 of his right shares and subscribed the rest. Then, company proposed dividends for the shares. And also tells about the adjustments of the dividend on the shares acquired on June 20th, 2011. Then, Sunder sold 25,000 shares of him at Rs 15 per share. So, we have to prepare investment account and an abstract of P&L account. For computation of cost, we should use average cost method. We have gone through the question, so we can prepare investment account. On April 1st, we have the balance brought down of 25,000 shares at Rs 15, which is 375,000. Then, we will post the purchase entry of 5,000 shares at Rs 16 per share. That is Rs 80,000. Then, Sunder received 5,000 bonus shares. For that no cost has to be entered, as there is no cost involved on purchase. Then, Sunder subscribed 2/3 of his right option, which is 10,000 shares, at Rs 15 per share. And sold the unsubscribed shares at Rs 2 per share, which we will treat in P&L account. Then, we receive dividend at 20%. On that, we have to adjust the dividend received on shares purchased on June 20th, against the cost of purchase. So 10,000 has to be adjusted, and we will discuss its calculation on workings. Then, Sunder sold 25,000 shares at Rs 15 per share. That's 375,000. So we have to compute the profit or loss on sale by using weighted average cost method. Computations are available on workings, hence we will discuss it there. Then, we have to balance that account, so the amount to be carried down can be determined. We have one more part on the problem. That is, preparation of P&L account. We will discuss and go through the workings. In P&L account, we have 3 items. 1. Profit on sale of shares. 2. Amount received on sale of unexercised right shares. 3. Dividend received on 25,000 shares, as the dividend of the 5,000 shares has been adjusted against the cost of purchase. We know, all the three are incomes for Sunder. So we will show it on the credit side of the P&L account, and we will have balance on the debit side. On workings, computation of number of bonus shares and right shares are not much complicated, as the question mentions about clearly. Then, 1/3 of the right shares, that is 5,000 share, sold at ₹2 each. So ₹10,000 received has been shown in the credit side of the P&L account. Then, dividend received on shares. That is, on shares held on April 1st and shares purchased on June 20th. On shares held on April 1st, dividend equals 20% of 25,000 into 10, equal to 50,000. On shares purchased on June 20th, dividend equals 20% of 5,000 into 10, equal to 10,000. This is what we have adjusted against the cost of purchase in investment account. Then, we have to determine, whether her profit or loss on sale on weighted average cost method. We know, profit on sale equals sale proceeds minus average cost. And the sale proceeds is 375,000. So we have to find average cost. Average cost equals 375,000 plus 80,000 plus 150,000, then we get total purchase cost, then we deduct the dividend received, which is adjusted against the cost of purchase from this. That is ₹10,000. So total purchase cost equals 595,000. Then, we had 45,000 in all. But now, we sold 25,000. So value of these 25,000 shares equals 595,000 into 25,000 divided by 45,000. So we get ₹330,556. So we have a profit on this sale, because our sale price is higher than the cost of purchase. That is, ₹375,000 minus 330,556, which is equals 44,444, the profit on sale. I hope that the above discussed will be helpful for you. Thank you.